you need to be in equities?
Well, Manan Desai is 25 years old. He's a qualified engineer and he's running a successful manufacturing unit as well. But that's not where his dream is. He wants to be producing music videos. He wants to start a production house. And beyond that, he wants to be driving his own Mercedes-Benz as well. That's his dream. Now, his question to us is, can he afford it all?
Hi, my name is Manan Desai. I'm a second generation entrepreneur. What I'm really passionate about is media and entertainment, to be precise movies, and want to set up a business of my own in the area of media and entertainment by having a production house at the age of say 30 to 35. I'm also a very adventurous person and really like driving a lot, and I'm fond of cars, and I want to have a luxury car in Mercedes by the age of 35 if possible. The philosophy in life which I share is that you either do it differently or don't do it at all. So whatever I want to do in life, it has to be different and appealing to people. So I really hope that whatever goals I've set up for myself are fulfilled. Can I afford to fulfill both my ambitions?
Traffic in Mumbai can be such a pain sometimes, but of course, as far as Manan is concerned, we don't want his dreams to get stuck in traffic. Here's what he brings to the table to make his dreams possible. Manan's monthly income is 50,000 rupees. He also gets incentives that add up to around 2 lakh rupees a year, which makes his annual income 8 lakh rupees. His total savings to date add up to 6 lakh rupees. As far as his investments are concerned, he's put in 1 lakh rupees in mutual funds, 2 lakh rupees in equities, 1 lakh rupees is in fixed deposits, and he's got cash in hand of 50,000 rupees. His current expenses every month are anything in the range of 10 and 15,000 rupees. So with all of that on the table, now Manan's wondering whether he can afford to have his 2 dreams fulfilled. To answer that question, we toss it over to a financial trainer, Amit Trivedi.
Looking at your present cash flow, getting your production house by the age of 30 and your Merc by 35, that looks quite stretched, because I was running the numbers and the return requirement from your investments would be in excess of 50% annualized compounded, which is a very, very high target.
Correct. But do you suggest that say in this period between the age of 25 to 30, when I'm actually earning, say if my rate of earning changes, is it possible for me to achieve the same in a timeline where at the age of 30 I am able to have my production house and by 35 a Mercedes?
One of the ways of achieving your goals as per the desired timeline is to increase the gap between the income and expenses.
Right.
Some people may reduce their expenses and increase the gap, but I think in your case expenses are at a reasonable level and there is a potential to grow your income also. Looking at the rate of return required, which works out to more than 50%,
right,
I think bringing that rate down to a manageable level is challenging. How fast your income grows,
right?
I think that's something that we need to really look at. Assuming very high growth rates, the chances of failure are higher. So if we start with some reasonable expectations, that is better.
Then could you suggest me some another line at which I should be looking at to achieve these goals?
If you delay your goals by a few years, and I was running the numbers, if you delay both your goals by 5 years each, and then these goals become achievable.
Right.
Even with your present level of earnings and expenses, if they grow at the rate of normal inflation, I put the inflation figure at 6%.
Right.
So both your income and expenses continue to grow at the rate of 6% over the next 10-15 years. Then also both your goals are achievable.
Right.
For that, I would recommend that you need to have slightly higher allocation towards a combination of equity and real estate. Why am I saying equity and real estate? Because both are ownership assets, both are inflation proof, so they can give you inflation adjusted better returns. But a diversified equity fund, actively managed, or simply a low cost index fund, would be a better idea.
So basically you are suggesting that I should put my money in mutual funds, or you suggest that do I take a direct exposure in equity?
I think, as I mentioned earlier, I would prefer mutual fund approach.
Because to be very frank with you, I have not been much comfortable with mutual funds.
Okay.
With market crashing, I don't want other people to decide that which stock they invest in on my behalf. So I feel mutual fund might not be the right way for me to invest in the market.
We're taking a small pit stop to refuel for a bit, but of course we don't want our man Manan's dreams to get stalled for any reason. Now he's thinking mutual funds is not his scene, and the reason is of course quite clear, the way the markets are moving. He doesn't trust anyone with his money, least of all a fund manager. But what are the other options available for him? To find out that, we toss it over to a financial trainer again, Amit Trivedi.
Manan, I think it's a very valid observation, very valid point. However, I would still go back to the income expense equation part which I mentioned earlier. How can you enhance your income? You can enhance your income by investing your knowledge, your time, your energies into your profession. Because between the profession and investment, generally it is the profession which generates much higher income, much higher level of income as compared to investments. And I also mentioned that between a diversified mutual fund or an index fund, you may also look at an index fund. Why am I recommending that? Because I believe that the asset class equity itself has the potential to deliver superior returns compared to other asset classes. So I am saying you would be better off concentrating on your profession and increasing the income there. The point here is, do you really want to spend that time and generate that 2% extra, or rather focus more on your profession and generate that 20% or 200% extra? So based on the discussion, I think there are a few points. One is, try and see how you can increase your income. At the same time, be flexible about the timeline of your goals. So if you have to delay the goals by a couple of years or maybe 4 or 5 years, be flexible, be open about it.
Right.
And whatever your savings, barring the fixed deposit that you have, which is a sweep-in account, and some amount in cash or bank, barring that, I think you should keep putting your money in a diversified equity fund or a low-cost index fund.
Right.
Do a systematic investing month after month. Regularly your money goes into that, and you're free to devote all your time into your business.
Correct.
Fueled up and ready to go. Well, Manan's dream is ready to go as well. His dreams are all sorted as far as Amit is concerned. He's showed him the way. If you have a dream that's stuck somewhere because of the want of a financial plan, don't worry. Just tell us about it. Our email ID remains the same. It's smartmoney@utvi.com. We're taking a small break right now on this episode of Smart Money, but we'll be back to tell you how you can make use of interest rates going down. There are certain investments that you can make. Karthik Javeri is joining me in just a bit. I'm going to join him over there at Narman Point. But of course, right now a small break, and as we do, a suggestion from Smart Money. Take a look at this.
This program is brought to you by ING, Banking, Investments, Life Insurance. And new Fiat Linea, admiration guaranteed. And Sector, no limit watches for men.
Strong coffee?
आपको लगता है रिटायर होने पे जिंदगी ऐसी ही होगी?
क्यों ना?
पर ऐसा ना हुआ तो बिरला सन लाइफ इंश्योरेंस के रिटायरमेंट सॉल्यूशंस, ताकि महंगाई चाहे बढ़ती रहे, आप कल भी जिए आज की तरह।
एक और कॉफी?
What's going on?
We're going green.
Green?
New software.
Software can help us go green?
It's all about automation, consolidation, efficiency. We'll save millions in IT spending and energy costs.
Millions.
Millions.
How much did we spend on energy last year?
Millions.
Millions.
Get used to it.
चाहे हो इनकी तरह एक सीधा साधा इंसान, बिल्लू 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 बाल काटने वाले, एक परफेक्ट हाउसवाइफ, शरारती बच्चे,
शैतान माँ को ऐसे बोलता है,
या इनकी तरह एक ग्लैमरस सुपरस्टार। टपरवेयर है सबके लिए। टपरवेयर खाने में फ्रेशनेस कर दे लॉक, खाना रखे टेस्टी राउंड द क्लॉक। टपरवेयर, द बेस्ट इन फूड स्टोरेज, इन एसोसिएशन विद बिल्लू बार्बर।
You know what? You're the biggest ever. Sick.
Hello again on Smart Money. Here we are on a rather windy day at Nariman Point. I was just speaking to Karthik Jhaveri. With interest rates going down, how is the scenario changing for investors like you and me? Karthik, you have ideas?
Basically what happens as soon as the interest rate falls, obviously an investor is looking for a better rate of return on his money.
Right.
To put an example to that, if I'm earning 8% and if the rate of interest is going to go down, which means say I'm going to now earn 6 or 7%,
yes,
I want more return for my money.
Right.
And which is why I'm going to look for another avenue which is going to give me better rate of return. That's what it means.
All right. So then, in terms of investments, then where should I be looking now? Equity markets are one place where many of our investors put in a lot of money. You have been saying on a lot of our episodes that you need to have exposure to equity.
Absolutely.
And now is the time to start, if at all you haven't yet.
Correct.
As far as the stock markets are concerned, with interest rates going down, how do you see that getting affected?
See, obviously, as soon as money becomes cheaper, all corporations, all institutions, everyone has borrowed some money, right? So if the cost of borrowing money or the cost of debt, as soon as that goes down, automatically profitability improves, everything else remaining the same. Sales remain same, cost of manufacturing remaining the same. If everything is going to remain the same, just that your money is now cheaper, obviously you make more profit, and more profit means better pricing of the shares and better valuation. So thus you make money on equities. If the rate goes down from 9% to say my average rate is now 7.5% or 8%, it will take some time for my balance sheet to reflect that profitability. And that's the time analysts will pick it up, and that's the time the investor interest will heighten in my company's stock.
Sure.
And that's the time the stock market will. So there is a lag effect. There will be a 6-month to a 9-month lag effect.
In fact, we have a viewer, Udayan is his name. Now, he's got a certain question because he's made certain investments already. As far as the markets are concerned, he's put money in mutual funds and equities and beyond. Let's just find out what he has to ask us.
Meet Udayan, 33, a long-standing soldier of the private sector, a recent entrant into matrimonial bliss and with a small set of loans to pay off. 4 to 5 lakh on the home he purchased, 2 lakhs on a car loan, 1 lakh in equities and 30,000 in debt funds. And now, with interest rates sliding down and not looking to go upwards anytime soon, is it going to do any wonders for Udayan, who's already made his investment choices?
Right, so what does someone like Udayan do now that he's made certain investments already?
That's right.
What exactly can he do now that interest rates are falling?
A little bit of restructuring there to get into large caps, the blue chips which will move up faster.
Right.
So move into those kind of stocks. Mutual fund obviously continue to hold. That when the rates are dropping, the effect will take some time to come.
Sure.
Invest in those assets which are going to benefit as a result of interest rate coming down. Don't be in a hurry to prepay your home loan. So go easy on the home loans. Don't be in a hurry to pay them off because your house is an appreciating asset.
Right.
It's going to make money for you. Worst case scenario, it will still grow in line with inflation.
Right.
So invest your money elsewhere. Wait for some time. Wait for 2 years, 3 years. You will get large profits. And that time when the rates start moving up, that's the ideal time to make a prepayment.
Also, because we are nearing the 31st of March and talking about lock-in periods as well,
Right.
there is ELSS and other kind of investments
That's
as
right.
well. How do you rate them where the interest rates are going down?
See, obviously a fund like an ELSS fund or any other equity fund is going to directly translate into profitability for the company.
Right.
So if you are going to make your tax savings, then better go to an ELSS because then there's a probability that in 3 years you will make a substantially handsome return is very, very high. And the cycle will turn around in the next 2 to 3 years and you will have a lot of profits to make. But you see, you got to wait for some time because right now the banks are not immediately reducing the loan.
This is what I've heard now. Of course, interest rates are going down, but banks are not very happy to give out those loans until they're very sure about the credit worthiness of the people they're lending it out to.
One, they don't want to be saddled with more NPAs, and because there's a general downtrend everywhere, everybody is locked in with more inventories, stocks are piling up, sales are not happening. At this time, the banks are a little apprehensive about lending unless it's an extremely good case where they would lend and they would make returns. But as soon as you drop the rates, obviously demand will go up for the loans. So they're holding on to that. So, we'll have to bear with that till about, I'm guessing, April or May.
Now at this kind of time, would you actually buy into it with interest rates going down?
In real estate, the prices have crashed about 30 to 40%, but not many would be willing to accept it.
Sure.
So even if there is a cheaper loan available, there are not enough buyers, or if there are buyers, they are not willing to make that decision right now. They're thinking it will fall even further. About 6 months is more the time period that we're looking at, and within which the rates should stabilize. They should come down even further, maybe 20-30% more. But start giving your offers. It's a buyer's market now.
Right.
What you need to do, if you're really buying a real estate, make an offer.
Right.
You might be lucky, you might strike a deal.
Sure.
If you're not going to strike a deal now, you'll strike a deal 3 months later on.
Right.
But start investigating. You might get a deal now, you might get a deal even 6 months down the line.
Correct.
Keep it ready. Get your sanction letter in order. okay, and go on to a floating rate because the rates are going to go down. So obviously you don't want to be in a fixed loan scenario. You want to be in a floating rate scenario. So you have your money ready. As soon as you get your deal, make your move.
All right. Sounds like fair advice. Karthik, thanks very much for joining us.
Pleasure always.
Sharing all those ideas. With interest rates going down, there is a world of opportunity that is coming up, and stock market likely to go up as well, going ahead as Karthik is suggesting. Now, of course, we are talking about the equity markets. Where do you exactly park your money? In case you're looking at putting in money in the equity markets, we have some suggestions for you. Take a look at this.
Stay away. If you are looking for short-term gains from the stock market, this is not the time. Interest rates have been on a downward spiral since September last year, and the ticker pundits hoped that the Sensex would rise. But that was not to be, as the markets reacted in a lukewarm manner. Lessons learned from the bankruptcy of Lehman Brothers, Merrill Lynch and Company ensured that the banks are a little hesitant to lend to one and all. So in such a scenario, invest in equities only if looking at a period of more than 2 years. And if you are, then these are the sectors you should look at investing in. Banking is a good bet, especially public sector banks, which are now cash rich thanks to government securities. The other option is companies like BHEL, ABB and HUL, which have low exposure to debt.
We are advising our investors to look at companies where there is no debt, or companies which are low on debt. Besides this, we are also bullish on the prospects of Indian banks, particularly, and to be precise, PSU banks, where we think that their NPA will be in under manageable limits because of their risk aversion in lending.
And these ones are a strict no-no. Auto, real estate, infrastructure and metals. These have not fared too well in earnings season and are the worst victims of the volatile market. For instance, stocks like DLF, Unitech and Tata Motors, to name a few.
It will take a lot of time when consumer will have money in the pocket and will go out aggressively to buy their houses or cars or other stuff. So I am not very optimistic in 2009 for these industries per se.
If not direct equity, you could go for an equity diversified fund, which is a fund that is a judicious mix of sectors with large cap companies, or through a systematic transfer plan. You could also invest in a gold fund. And an expert tip, block 25 to 30% of your investments in fixed deposits of public sector banks so that this very money can be used to buy shares in 2010. Do avoid government securities. Also skip debt funds, as there is a risk of default due to downgrading of corporate portfolios.
Now, those are some ideas for equity investments, but of course, lots more tips and answers to all the questions that you've sent us coming up in Smartbox in just a bit. But of course, before we get into that break, here are some more tips coming your way.
The government slashing rates does not mean the banks are going to cut their interest rates pronto. The banks don't want to be caught with too many outstanding loans on their balance sheet before Judgment Day, 31st of March, the final day for filing tax returns. Give it another 4 to 6 months and you should be set to get your home loan at a cheaper rate than before.
Strong coffee?
आपको लगता है रिटायर होने पे जिंदगी ऐसी ही होगी?
क्यों ना?
पर ऐसा ना हुआ तो बिरला सन लाइफ इंश्योरेंस के रिटायरमेंट सॉल्यूशंस, ताकि महंगाई चाहे बढ़ती रहे, आप कल भी जिए आज की तरह।
एक और कॉफी?
आप अपने पैसों का सम्मान करते हैं, उनका आदर करते हैं, इज्जत करते हैं। इसीलिए हम MF ग्लोबल में आपके पैसों की कदर करते हैं। ड्रेस कोड रीड एंड टेल। चाहे हो इनकी तरह एक सीधा साधा इंसान,
बिल्लू 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 बाल काटने वाले,
एक परफेक्ट हाउसवाइफ, शरारती बच्चे
शैतान माँ को ऐसे बोलता है
या इनकी तरह एक ग्लैमरस सुपरस्टार। टपरवेयर है सबके लिए। टपरवेयर खाने में फ्रेशनेस कर दे लॉक, खाना रखे टेस्टी राउंड द क्लॉक। Tupperware, the best in food storage, in association with Billu Barber.
This program is brought to you by Smirnoff Cassettes and CDs. Life is calling. Where are you?
The show is called Smart Money, and there's a reason why we call it that, because it's all about your hard-earned money and how to make the most of it so that you make the right kind of investments that last in the long run. Of course, as far as the Idiot Box is concerned, it's no longer the Idiot Box. We've decided to call it the Smart Box. You send us a lot of questions, we answer with a lot of smart answers. So here's the Smart Box with all your questions answered.
Hi, I'm Jigar Vora. I wanted to know what should be my strategy regarding entry and exit load while choosing a mutual fund to invest in.
Well, as far as entry loads and exit loads are concerned, they are part of the expense ratio, and every investor must find out as to what are the provisions relating to entry load and exit load before he invests. In equity mutual funds, they are not so important because normally one should be investing for long term, and in long term there is no exit load if you exit after 3 years or 5 years or so. Exit load and entry loads are more important, particularly in income funds where you are investing for short terms, say like 6 months to 15 months. There it's very important that you find out how much it's going to cost you.
Hi, I'm Anushka Paul. I'm a first-time investor and I wanted to know whether it's a good time to invest in gold.
If you're a first-time investor, I'm assuming you must be very young. You don't really need to invest too much in gold. Even if you were to put money in gold, put only about 10% of what you can afford to put as an investment. So if you're investing 10,000 rupees, don't put more than 1,000 rupees a month in gold. Nothing beyond that. If you're a young investor, gold at best will protect your capital. It will not grow your capital. For growing your capital, you need to be in equities.
I am Shirish Vajpayee from Chennai. I am working in an IT firm. I want to withdraw all my PF amount. How can I withdraw my PF amount and how can I check how much amount is available in my PF?
As an employee, you get your PF account statement once every year around September, October. And PF office sends this to your employer and employer in turn sends it to the employee. That's how you get to know about your account balance in your PF account. Premature withdrawal from PF is allowed for certain purposes. It could be construction of a house, repayment of a housing loan, buying a house, children's education, marriage, or payment of insurance policy. There is a standard form which one needs to fill in. HR department of the company can help you out with the form. The limits of withdrawal as well as various other terms and conditions are very well spelled out in the form. Generally, it takes around 2 to 3 months from the date of filing that claim till receipt of money. So you must factor that amount, that time in.
There you go, all your questions answered right here on Smart Money on Smart Box. Don't forget, if you have more questions, you can send them across to us. Our email ID, that remains the same. That's smartmoney@utvi.com. And then, of course, there's the SMS number, which is 59995. All you have to do is SMS SMART. Put your name, your city, your question with spaces in between. You send it across to us. We'll answer it on Smart Box. With that, it's a wrap on this episode of Smart Money. Until we meet again, keep learning, keep watching on UTVI. Bye-bye.
This program is brought to you by ING, Banking, Investments, Life Insurance. And New Fiat Linea, Admiration Guaranteed. And Sector, No Limit Watches for Men.
Slow and steady is a thing of the past. To succeed, you've got to stay ahead of your time. Every morning at 8:45, get a heads up on the 15 cues that will shape the day's trade in just 15 minutes. Markets 15:15. Weekdays only on UTVI. Global presents Global Market DNA, the grand finale. At these times, only on UTVI.
Largely it is the property side, the casualty side and the asset side besides the health.
You are genuinely carrying a liability if you are not insured.
The real problem is that in terms of penetration, the insurance industry is very, very underpenetrated in India.
HDFC ERGO and UTVI present General Insurance Forum. At these times, only on UTVI.
Brought to you by HDFC ERGO General Insurance. हर पल आपके साथ.